Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories by Village Global. I'm here today joined by a very special guest, Jerry Neumann. Jerry, welcome to the podcast.
Hey Erik, I'm glid to be here.
Jerry, I want to start here. I want to get into Carlota Perez and the deployment phase, but I want to start with this tweet storm you had a few weeks ago that sort of introduced this idea, this question of whether if you have differentiated information, you should publicize it and whether you can make money off it. Perhaps I'm mischaracterizing. Why don't you characterize the punchline of that tweet storm, and then we can get to the content of Carlota's ideas and why they matter in venture.
Wish you had warned me about that one. I tweet a lot of stuff. What did I say?
Oh, that's okay. You're basically saying you can make your conclusion was you can make a lot of money in venture because people won't listen to your predictions. And you were saying the Carlota as an example that you've been publicizing it, but people still aren't following it.
Okay. Yeah. Right. So the idea being that this is sort of a pervasive idea in my thinking. I don't know if you've had this, but every once in a while somebody comes to me and says, "Hey, I've created a machine learning or artificial intelligence algorithm that can predict stock prices." And my usual response is, I don't think that's really possible, right? If you could predict stock prices, A, you wouldn't be asking me for money because you could predict stock prices, you could make money on your own. And B, if you could predict stock prices would respond to your ability to predict such that you would no longer be able to predict them, right? Any advantage you have would be arbitraged out of the market. And obviously, this is only true if you're doing it on a large enough scale. And so that's the kind of basic idea. You can pick holes in that all you want. But the idea that if you have some way of predicting the future, your predictions then become baked into what the future becomes. So your predictions can no longer be that accurate.
Yeah. This is sort of the economist version of, if you're so smart, why aren't you rich?
Yeah. Or, you can't find a $20 bill on the sidewalk. Did you ever read the Foundation series by Asimov?
I have not read them.
You should. It's about a guy who he's a scientist. He invents a way to predict the future, and he does it by using psychology of groups. So if you have a large enough group of people, then you can predict what they will do. And it's an interesting premise. But even in the book, Asimov says, this whole thing had to be kept secret, and the predictions couldn't be unveiled ahead of time because then they wouldn't come true. And I think that's just it's a feature of any sort of social system that can adjust that can adjust itself, that can recalibrate itself, is that if you make predictions and people are like, oh, those predictions are true, then they may or may not be true. So if everybody believed Carlota Perez's ideas, there's two possible outcomes. Either they become more true because people just do what they say, and this is sort of like Moore's law, right? Why is Moore's law true? Well, Moore's law was true because everybody believed it would be true.
Yeah.
Right? I mean, why? There's no clock in technology progression, right? So why would the number of transistors on a piece of silicon double every 18 months? Well, it's because that's what people plan for, all the big semiconductor companies. So predictions can be self-fulfilling in that way, or it can be that if you say like, well, this is what's going to happen, everybody adjusts to that happening and then it doesn't happen.
Yeah, an example of the latter might be the crypto space where people are saying, hey, is anything interesting going to be happening here? All these talented people are working on it. And it's almost by definition, because there's so many talented people working on it, something interesting might emerge.
Yeah, and that's definitely a self-fulfilling prophecy. I think the idea that you can influence the future by creating a narrative around the future has always been true. One of the if you go back and you read Rogers on diffusion of innovations, one of the things he talks about is you can have innovations diffused by telling a story that people will believe. And if you think about the early days of the personal computer, this was clearly true. There were a lot of people telling stories about the personal computer, about how it was going to change the world, even before people knew how it was going to be used or what it would be used for. What would you use a personal computer for? In 1977, there was no spreadsheets. The word processors weren't that great. There was no real use yet for having a computer in your house other than playing video games. And the Atari 2600 was better at that than the Apple II. But people still bought them because they believed that the world was going to change because of these PCs, and they wanted to be in on it before it happened. They wanted to be part of that. So this was an example of a narrative changing the adoption of the technology itself. So that definitely happens. The future can be influenced by how you frame it for people.
Yeah, it's fast. I'm excited about prediction markets and allowing people to have more stake in the skin in the game. And we see it with gambling. We see it, it's with sports. It's just interesting to see as that permeates across society what effects that might have.
Yeah, the tweet storm now that you've reminded me what it is, was saying that basically, if people had believed Carlota Perez's theories when I had when I had summarized her book, 5-6 years ago, whenever that was, and I certainly wasn't the first VC to talk about her, right? Fred Wilson was talking about her, Chris Dixon had talked about her, Mark Andreessen had talked about her, but if people had believed what she said at the time, then a lot of the things that happened wouldn't have happened, right? You wouldn't have had all these DTC companies. Well, maybe that's a different issue, but there's a lot of tech companies that wouldn't have been funded. So you could make money in VC by not believing her, but only because nobody else believed her.
Interesting. And talk more about the D2C thing for a second. I know it's a different issue, but you tweeted about Casper this morning, so I know it's at the top of mind. But when we talk about that,
I've been using Casper as an example for my entrepreneurship class for a year and a half now, about how hard it is to build a sustainable competitive advantage. And obviously, the sustainable competitive advantage Casper is trying to build is their brand. They drop ship pieces of foam. There's no difference in their business that anybody else can't mimic, right? But they do have a brand, and that brand was just very expensive to build. So they raised a bunch of money, and now they're going public, and they're worth a bunch of money, but not a whole heck of a lot more than the amount of money they raised. So it's extremely expensive to build that kind of moat, a brand. And the better kind of moat to build is something where it's hard for other people to replicate what you do, right? Your activities. And that's obviously not my idea. That's comes out of Porter and value chains. But a lot of these DTC brands, the food delivery companies are so easy to replicate that even if any one company makes money, it's almost inconceivable that the sector as a whole will make money. And I've written about this from in the 80s with the office supply superstores or the disk drive companies. There's certainly companies that made money in those sectors, but it was the sector as a whole didn't make money for the investors because there were so many companies in them.
Right. And what are your ideas and moats relative to perhaps others in terms of what do you think people misunderstand about moats or don't fully appreciate? So
my current line of thinking is that as a startup, you can't really have a moat, right? You can't have value from a moat. That moats create, to create a moat, you either have to have time or money. And you don't have really either of those things at the very beginning of your startup. Even if you show up with a patent, say, which is sort of the prototypical moat, you show up with a patent and you say, look, this patent is my moat. Nobody else can do what I'm doing, so my startup's worth something. I really don't think that's how startups create value, right? Like you look at Google with their patents on PageRank, and Yahoo, they tried to sell that technology to Yahoo for $1 million, and Yahoo turned them down. All the search engines at the time turned them down because the patent wasn't worth much. So where was the value that they built? How did they build value in the face of all this competition with even, with the patent sort of not being the moat? And I think the answer is that nobody else believed what they were doing, right? Nobody else believed there was a market for what they were doing because they were coming in and saying, hey, you're not going to make money from the kind of advertising that Yahoo and Excite are doing. You're not going to be portals where people spend as much time as possible on your site. You're going to come in, you're going to search something, you're going to go. And that's the value. That's what the customers are at a search engine for. If you do that for the customer, you're going to have a lot more customers. And Yahoo and Excite said, well, but if you do that, then they don't see that many pages, right? So they're going to see one page and then leave. There's not enough. You don't have them there long enough to make money. So, supposedly one of the search engine CEOs said to me, when they came in, they said, well, this was Excite. Said, we'd really rather have search that was 80% as good as everybody else because we don't want people to leave the site, right? We want people to stay and look at our content. So Google comes along and says, hey, well, we want people to show up, type in one thing, and then leave because that's what they're here for. And everybody else says that's not going to work. It's not going to work as a business. So the moat they had, the reason why nobody else replicated them wasn't because of the patent. It was because nobody else believed in what they were doing, right? There was this fundamental uncertainty about what was going to happen to their business. So was it a business at all? Where were you going? What was the goal? Was it feasible to reach whatever that goal was? And it was this uncertainty that kept everybody else out until they could build a moat. And I think that's, similar to, if you were Apple in 1976, why didn't IBM come in and compete with you? IBM was the undisputed master of computers. They'd been in the computer business for, decades at that point. They were a huge company, one of the biggest companies in America. And yet they didn't go and say, well, let's compete with Apple and build personal computers. And the reason was because they didn't think there was a market for personal computers. And the reason they didn't think there was a market was because there was no market for personal computers at the time. And they couldn't imagine that changing because there was no data to say like, well, this is what people want, right? You couldn't have gone out and done customer development and said, hey, what problems are you solving that a personal computer would solve? There were none, right? Home computers, like what problems did people have at home that a personal computer was good for? It's just, there were none. So that market was created, but because it hadn't been created yet, people said, well, it doesn't exist. So it wasn't until 1981, 1982 that IBM said, well, wait, this market does exist and we should build a product and compete with Apple. And by that time, Apple was already public. They were a Fortune 500 company. They were big enough to defend themselves against IBM, although they still almost lost. But it was that period of uncertainty about the market that gave them this ability to grow without a moat.
Yeah.
So this is what I'm thinking about right now.
And it's interesting, the Yahoo Google example, because today there's such a focus on trying to own the whole value chain. So where does that come from, and how does that square with the Yahoo Google example, where Yahoo tried to do that and it seemed like it didn't work, whereas Google focused on dominating one element of it and obviously became a much bigger business?
I really think that if you're going into a business where there's not a lot of uncertainty, where it's predictable, where you can say like, this is what's going to happen. This is how big the market is. This is the product that people want. This is what we have to do to win. Then it's not a market that's worth going into, because then what you're saying is the way we're going to win against everybody else who can see the exact same facts we can see is by being better operators, right? I mean, and that may be true that you're a better operator. I mean, there's certainly somebody has to be the best operator. But generally, if you're the better operator, you can probably go get a job at some Fortune 500 company and make a ton of money, right? I mean, it's not usually the people who are, in their 20s, coming out of college, who are your prototypical startup entrepreneurs who are necessarily the best operators in the world. I never look at my founders and say, are these people going to be the best managers ever? Because I think, A, there's no way to know, and B, like, it's a little unrealistic of me to expect that from people who've probably never started a business before. And if they are the best operator ever, then shouldn't they be running, General Motors or something? It's, so I think, you need something besides that. I mean, not that people aren't important. People are obviously the most important thing to me, but not that.
So you don't want them to own the whole value chain. You want them to sort of change the value chain.
I want them to do something that other people and other companies think, or not that they think won't work, but they just have no idea, right? It's, sometimes I'll look at a company and then I'll talk to another venture capitalist about it, trying to build a syndicate. And, I'll listen to what they say. And if they say like, that won't work, I'll say, well, what do you mean it won't work? And if they're saying like, here are the reasons it won't work, like there's actual data to back up why it won't work. Okay. Maybe it won't work. But if what they're saying is, I don't know if it will work or not. All right, well, that might be a good place to invest, because you want to invest in the places where you don't know, right? And I think, look, why would you own the entire value chain? It's not like I suppose there are circumstances where you need to own the entire value chain. And I probably have invested in some of them, but I can't think of them off the top of my head. But I think generally you should focus on the one thing where you can really create value. And I think that one thing is the place where there is the uncertainty. And there's almost never uncertainty across the entire value chain. Owning the entire value chain is more of a way to try to create a moat to prevent competition. And again, I think to do that, you're either spending the time or the money. So my analysis doesn't apply to like Series C companies, right? If you're Series C and you're trying to own the entire value chain, fine. I don't consider that a startup, right? That's way past where I invest. I'm thinking of companies that are starting right out of the blocks, and I invest in 2 people in an idea. So certainly it's different.
So in contrast, typically to the lean startup, a Steve Blank philosophy, Keith Rabois says that product market fit is forged, not discovered, and it's sort of like casting a movie. You set the vision, you find the actors, and then you execute. Do you differ from that?
I disagree with pretty much everything Keith Rabois says except for that. Although I do disagree that there's really, you can make any single statements about startups and have them be true across everything, right? And I think he would probably agree with that. Product market fit can be forged. Yeah, I think that's the idea we were talking about before, narrative, right? You can create product market fit. I mean, I was thinking about a couple months ago, I think I wrote about it, that, can you imagine an alternative present where instead of Apple being the prototype for the personal computer, came out of Atari, right? Where it wasn't a screen with a keyboard, it was, a console with a joystick, and that it was much more gesture based. And I think you can imagine that, right? You can imagine that happening. That really wasn't where Atari was going with that. And people adopted the Apple model because of the types of uses that became popular earlier. But, you can imagine an alternative scenario where it turned out differently. And the reason it didn't was because there was actually a ton of people trying to convince everybody that this kind of personal computer was the future. There were computer user group, there were magazines, there were, a lot of PR, or, it wasn't even necessarily planned PR, but people talking to the media about how this was the future. And people read this stuff and said, well, this is the future. They were convinced this was the future. And so it did become the future, right? It was that kind of self-fulfilling thing we had talked about before. So yeah, you can create product market fit. Now, that's true in some senses where what the eventual product will be is unknown, right? If the uncertainty is around what it is that people actually want, then yeah, you can create it, right? You can create your market. There's a different kind of thing where, like, if you're a biotech company and you're building a drug that will cure cancer, to use a pretty broad brush, then yeah, product market fit is, what that is, right? You're not creating product market fit. Product market fit is a drug that cures cancer, right? You're trying to find that. The uncertainty is around how to do that, the means to do that, not the goal. So I think there's there's a lot of places where uncertainty can come from. It can come from your means, like what do you have, what can you do? It can come from where you're hoping to end up. Where certainly when Google started, they had no idea where they'd end up, right? They, their goal was
make all the information accessible.
Yeah, I mean something like that, right? Which is like not really a goal. That's that's pretty vague. But they knew what they had, right? They didn't have any uncertainty about the technology they had. They just didn't know where they were going with it. And they famously published a paper saying, we don't believe that advertising, that search engines should make their money from advertising because it's an inherent conflict of interest. And it was, then resolving that conflict of interest that created the multi-billion-dollar company that it is today. So where's the uncertainty here? Is it in the means? Is it in the ends? Is it in how the means and ends connect? Is it in how your competitors will respond? Each of these different types of uncertainty will change how you should respond. And it will change things like, what does product market fit mean? Is it important? It'll change like whether or not lean is going to work. It'll change whether or not customer development will work. All these things change based on where the uncertainty come from. So I don't think you can make any sort of dispositive statements and say, this is always true.
Yeah. What uncertainty are you most interested in taking versus what uncertainty will you not take?
I really prefer the uncertainty around what are the goals. So I sincerely dislike uncertainty around means. Can we do this or not? Can we? I think of that more as like research and development. Like I would be an awful biotech investor. We're out experimenting, trying to figure out if we can create a cancer drug. That's the kind of uncertainty I hate, and I'm not equipped to take it. But people make money doing that. I much prefer we have something that does something really interesting. We think there's a market that could be enormous. There's some scenario where this could become enormous, but we don't really know how we're going to get from here to there. So we're going to be going out into market and trying it with a bunch of different people and seeing how they use it, how they respond to it, and then adapting our technology or our product to whatever use is the highest value. That's the kind of thing I really prefer.
And why do you prefer it? Because you can help more there, or because you think it's likely to be more, upside businesses, harder to compete with?
I think it's a better fit for venture capital. I have been in companies that are R&D type companies, and it's that's a game for people who have a lot more money than I have. You look at like General Electric with engineered plastics. It took them supposedly 20 years and $1 billion to perfect the engineered plastics before they really had a business. So, they probably didn't think it was going to be 20 years and $1 billion when they started. They probably, whoever pitched that original plan at GE probably said, oh yeah, that's going to be like 1 year and, $10 million. And then every year it just grew and grew. And it was probably worth it in the end for them. But I don't have 20 years and $1 billion. So that's not the kind of thing I want to fund. And I don't want to take that kind of uncertainty because it's sort of an unbounded uncertainty, right? It's whereas if you invest money in a company where you're not sure where it's going to end up, well, worst case is you lose the money you invested, not that you have to invest another $1 billion. So it's, I think it fits the venture capital model better. I think it's also just what I'm more familiar with. I think most of the companies that I think about as success stories were ones that built their market, that didn't know what their market was when they started. They may have had some idea, but didn't necessarily turn out that that market was the one they ended up in.
Yeah.
So it's, something that I feel more familiar with. It's also, I think, being more familiar with it is easier to help founders navigate that kind of uncertainty.
Let's go back to Carlota's ideas. You mentioned that most VCs didn't take her ideas seriously. What would have looked like what would they have done if they had taken her ideas differently? What would be different? And broadly, how can her ideas help, say, me be a better venture capitalist in 2020, or if I was in 2000, or if I was in 2040? How should we understand them as it relates to doing venture capital?
Well, the glaring thing that she says is that when you get to the deployment age, the second half of the technological cycle, that the casino capitalism is gone and that innovation is funded by incumbents, right? That it's production capital, not necessarily funded by incumbents, but it's production capital, that people will build things that improve existing technologies, not introduce radically new technologies. And if that's true, then the role of the venture capitalist itself is very different, right? And I think what it means is you're going to have people investing more money at a later stage in things that create less value. So both funds need to be larger and they'll have lower returns, right? Because sustaining innovation, the kind of incremental innovation that happens every day, everywhere, in every company, every good company in America and around the world, is slow and steady. It's not big leaps. So there's not a ton of money to be made doing that because the IRR in it just isn't as high. Now it's more certain, right? You have a lot fewer failures. So the expected IRR overall might be the same, but that's not what venture capitalists do, right? You're not making bets when you're doing incremental innovation. So that's kind of the glaring point was, Carlota Perez says at one point in one of her papers that the job of venture capital is done, or the job of financial capital is done. And we, the venture capitalists, are financial capital, right? That's what we do. So that's the first point. If they really believed it, they would have retired. Now, the second point, and you can argue about that. I mean, obviously, depending on when the deployment age really started, venture capital has gotten a lot bigger. It's continued to deliver the way it always has when the buying low and selling high, right? And the people who invested in 2008 through 2010 are exiting now or making a lot of money. But on the other hand, it has become a different thing, right? There's the things like delivery companies are not radical innovation; they're sort of incremental innovation at best. But again, doesn't mean you can't make money doing it. The second point would be that, it's funny, when I published that thing 5 or 6 years ago, a lot of people, including a lot of venture capitalists, said, well, if this technological wave is done, if we're in the part where it's going to be a lot less interesting, a lot less radical, then we'll just invest in the next one, right? We'll start investing in, the nanotechnology or, whatever it is that's going to be the next thing. We can, as venture capitalists, we can fund the companies that are going to be the next wave and make money on those instead. And that's goes against what she said is going to happen, which is that when you get into this point in the technological cycle, people are not going to adopt entirely different things, right? They're going to use the stuff we have to make their lives better, not switch to a different technology entirely. And not until this wave starts to really kind of plateau will people say, okay, how am I going to keep making my life better if this technology has stagnated? So if you look around like in 1970 when this wave started, according to her timeline, the economy was pretty stagnant. Technological innovation from the earlier technology wave, the electricity and mass transit and et cetera had really stagnated, right? You had people introducing products like the electric knife or the electric can opener that weren't even incremental innovation. I mean, they weren't innovation. I mean, they weren't improving anybody's lives. So when we get to that point with the computer age, then people will start to say, all right, what else is out there that I can adopt? People like a certain amount of change, but right now people are sick and tired of the change. I think people are wishing that technology would slow down, that they could just have the time to adopt the technologies that's out there already. And you see this in the political and social discourse, right? So I think, the idea that one venture capitalist is going to step into the deployment age and, change the direction of the economy is silly, right? I mean, investing $2 million in a company can't change the direction of the economy. When you think about the adoption of computers as, a society, the amount of money that went into that was not the amount of money that was invested in an Apple computer in 1976 and 75. It was all the money that was invested in that, in the telecom lines, in the internet, in every router, in all of these companies spending a ton of money, all these programmers getting trained. It took decades, and an untold amount of resources, far more than any even the venture capital sector as a whole can command. It was a major part of the economy. So any new technological revolution has to have that kind of support within the economy at some point to really change the economy. And if it doesn't, then it's going to fail.
So is the message that if we were in the 90s, it's like that was the go time, that was when you were investing a lot, and how do we know when it's the next technological revolution, whether it's biotech or crypto or something else?
The post that I wrote immediately after that Carlota Perez post, which nobody read, everybody read the Carlota Perez post, but not the one I wrote immediately after, was that the reason that I wrote that post and that I explicated her ideas was that I hoped that people knowing this would change it, right? This is the business cycle that she talks about and that others have talked about isn't some sort of law of nature, right? It's a phenomenon that's emergent from our complex society. And that means that it's something that happens because we as a whole have sort of decided it's going to happen. It's not, so it can be changed. So if you really believe that, we have another 20 years of this before anything really new and interesting is going to happen, then, maybe that's just what you do. But you're going to keep investing in this, you're going to keep living in this, and you're not going to try to change much, which I think would be unfortunate, right? Because, one of the reasons I'm in this business is because I like change. I want to see change. I want to see what's, the next thing. I would love to watch nanotechnology start to work. I'd love to see quantum computing work. All of these things are just interesting to me, right? So the idea that we're kind of in this stagnant, like 1950s man in the gray flannel suit era is awful to me. That's just an awful idea. So I'd like to see it change. I'd like to see people continuing to try to change it. Sorry, go ahead.
How do we change it?
I don't know. I wish I knew. I think it's, and look, it's not like if you were living in the 1950s that you couldn't get involved in computers. Again, that was when the first computers were really being built, right? You could certainly have become a computer scientist back then and made a huge impact on how computers evolved because, when was the ENIAC introduced? Or the UNIVAC, sorry. UNIVAC was introduced like 1949, 1950, right? So that was in some sense, the golden age of explorers. But the thing is that you couldn't make money in computers as an independent then, right? The company that produced the UNIVAC, the two guys from UPenn who built the ENIAC went off and started a company called Eckert-Mauchly Computer. And they went out to try to raise independent capital to build the UNIVAC. And they couldn't. Nobody would put money into this crazy idea. And so they ended up selling to Burroughs, and Burroughs funded it. And that was the beginning of the commercial computing industry, digital computing industry, that gave rise to, IBM becoming one of the largest companies in the world. It probably would have been an interesting investment, but there was no risk capital for that sort of thing. It was production capital. So Burroughs was an existing company. They put their own money into it to build it internally. Eckert and Mauchly did not become very wealthy. It's just that's the way it was. They had a huge impact. The UNIVAC had a huge impact on how computers evolved. And so it depends on what you want, right? If you want to have a huge impact on whatever the next wave of technology is, and I don't know what it is, I can't really predict it, but you could be working on nanotechnology today, you could be working on quantum computing today, and people are. You just probably won't make a lot of money from it.
Right. Well, are there any criteria, like when will you make a lot of money for it, or any criteria that could help us point in the direction of, this might be the next technological revolution, or this is it when we'll be able to see it when it's happening? Is there? That's a good question. I think, if Perez basically at one point said that the turning point in this technological revolution was around 2001, the dot-com bubble bursting, et cetera. She's later amended it to say that it was somewhere between 2001 and 2008. In either case, if we're in the deployment age, which lasts, 30 to 40 years, then, we're maybe halfway through it. At about this point, you should start seeing the uses of the technology becoming less interesting generally, or not less interesting, less surprising. And I think that's pretty true. Yes, software is eating the rest of the world.
Or software has eaten the world, right? And now it's just basically it's eaten the world, and now it's just, all right, well, everybody expects it to be there, right? You wouldn't buy a product that didn't have some sort of information technology built into it unless it was something super simple, right? You kind of expect it, that if it can add value, it's already there, and that it works, and that, the Iowa caucuses aside, that, people know what they're doing when they build it, right? That's just a basic expectation. you're not going to buy a thermostat today that doesn't have a computer in it. So software has eaten the world, and now it's just kind of progressing along, getting slightly better every year, and it's boring, right? For the most part. Not that everything is boring. There's certainly some surprising stuff, that pops up. So yesterday, some guy took a neural network and took one of the early movies from like the 1910s and sharpened it so that it looked like it was shot in HD. All right, that was surprising. So there's still surprising things that'll pop up, but it's going to become a lot less frequent. So, if you think about the 1950s and 1960s, like what were the big technologies that made a big difference, right? There were computers, and they didn't make that big a difference then. They made a big difference later in the 70s, but not then. I mean, the most important technology of the 1950s and 1960s was containerization, and that made a big difference. But it was really much more of a deployment age technology where it took advantage of the existing infrastructure to improve it, not to make some sort of radical change. Although in some it made a radical change. And, who made money from containerization? Like certainly not the guy who invented it. I think it was spread out among a lot of existing operating companies, the money that was made.
I asked Carlota about crypto. She said it's not a new technological revolution. She says it's part of like the socioeconomic part of the existing one, and that it might help distribute capital in some different way. But she thinks biotech is going to be the next technological revolution. Do you have any reaction to either of those points?
My reaction would be that her own analysis suggests that we can't know ahead of time. So while we can always guess and we can be hopeful, right? I mean, biotechnology revolution would be great. We all want to live to be 500 years old, especially those of us who are a little older. Her theory says that you can't know, you can't know ahead of time, and I think that's partly my focus on uncertainty, is that there are a lot of things you can't know ahead of time, and the things that are most interesting you can't know ahead of time. Because if you knew them ahead of time, then they'd already be here, right? If you knew that biotechnology was the next technological revolution, people would be shoveling money into it now, right? So it wouldn't be the next one; it would be the current one. So, her saying that she thinks that is, I think that's partly like it's a candidate, and partly it's wishful thinking. She's previously said she thinks the kind of green revolution would be the next technological revolution, and I think that's also sort of wishful thinking. I mean, we all wish that would be, but I think there's no way of knowing. And I think even personal computers, there was no way of knowing until they became mainstream, right, in the 80s. Like you wouldn't have been able to tell in the 70s that was the next technological revolution. When the microprocessor was invented at Intel in the early 70s, even Intel didn't recognize its revolutionary potential. They didn't want to put resources into it. There was a manager there who convinced them to put resources into it. And I think he convinced Gordon Moore, like, look, we should do this. And he was like, all right, go ahead and try, but who cares? And then Intel was not the company that even took advantage of it, right? Like the Apple II didn't have an Intel processor in it. The TRS-80 didn't have an Intel processor in it. The Commodore 64 didn't have an Intel processor in it. It wasn't until 1981 that Intel processors entered the personal computer world in a big way with the IBM PC. And why? Well, because Intel didn't think it was important for 10 years, right? I mean, nobody knows. I think the idea that you can know it's unconstructive.
Yeah.
To be charitable.
Shifting gears a little bit, you had this sort of seminal post on portfolio theory, which basically sort of made the assertion or looking at the data that, hey, venture capitalists are not great at picking outliers. They make most of their money from outliers, and thus the implication and then maybe Sequoia has 5% unicorn rate. Most people have something like 1 or 2% or if that. And so the implication is, hey, you should make a lot of bets so that you have a chance to get an outlier. And you come to the opposite conclusion, which is that, hey, the more bets you make, the less you'll be good at picking and the less you can help your companies. And thus you should have a concentrated portfolio to maximize your odds of picking well and then helping well. Feel free to edit that characterization. I just real quick, I come to an opposite conclusion a little bit, which is I think YC has proven, not that it's a better strategy to have a wide portfolio, but that it can be just as good of a strategy if you figure out how to pick at scale without sacrificing your picking, and then support at scale without sacrificing your ability to support to the extent that you believe supporting helps. How would you edit or respond to my points?
Well, let me ask you a question first. Why do you think YC has been successful? Or what metric are you saying that YC is successful by?
It's a great question. I'm sort of speculating. I don't have their returns, but I'm assuming that if you get 7% of Airbnb and Dropbox and dozens of other unicorns that you've done well? I don't know. Was there a benchmark or something?
So this is a complicated question. I think everybody says that venture returns are power law distributed, and there's a lot of data that supports that. Although it's always hard to tell if it really is or isn't, because there isn't enough data. Which then would say, well, if you're on that power law, then yeah, you should have as many bets as possible. I do think that if you took all of the companies I see, not all the ones I invest in, but all the ones I see and all the ones you see, that those are not power law distributed, right? That the 80% of companies you don't invest in and the 50% of companies that you see that nobody invests in are probably not on that power law distribution. Now, it's hard to know, right? Because if nobody invests in them, they don't even have a chance. But I think there are some ideas that are just bad ideas, right? That you can kind of weed those out. So, whether or not that's true is a good question. It's a question of whether or not we can know anything, right? As investors. So if we can't, if it's true that those companies would also be on a power law, then we can't know anything, and we should just randomly pick companies to invest in. But none of us believe that, right? We all believe that it was Michael Mauboussin who said that the difference between the way that you can tell if something is pure luck is, can you pick losers, right? And if you can't pick losers, then it's luck. But I do think that in the companies that I've seen, that I can certainly pick some of them as losers. Like, this is just not going to work. So that means it's not all luck. And if it's not all luck, then being able to choose the ones that fit the power law is important. It means that the power law that we see in venture capital is a result of a picking process. So, even if it's just weeding out the things that will clearly not work, then what remains is the power law. So that means that to stay on that power law, you have to be able to pick. You have to be able to pick the things that are in the power law, the possibility of being on that power law. And if that's so, then you need to see enough stuff that the things you pick are on the power law. And if you just decide to invest in 80% of the things you see instead of 20% or 2% or whatever, then you're not going to be on the power law anymore. So this is, clearly a theoretical argument. Now, if you talk to people at some of the firms that have invested in a bazillion companies, there's some support for it anecdotally. YC is interesting, right? If you look at YC and you look at how many companies they've invested in that have become $1 billion plus companies, they have about the same proportion of $1 billion plus companies as I do in my 51 company portfolio. So I have 2 out of 51, and they've got, I don't know, some number out of a much, much larger number of investments. Now, YC is far more successful than I am because they get to invest at about a $250,000 pre-money price. And I have never gotten that price, right? Because they're taking a percentage of the company for a very, very small amount of money because they're offering these other services. So yeah, their IRR has got to be, astronomically higher than mine, but their success rate in picking is not higher than mine. So, in some sense that argues against saying, well, if you just have a much, much larger pool of candidates, you're going to have more outliers.
Right. But it also argues against necessarily the idea that your pick rate is going to get worse the more you have.
Yeah. Although, their pick rate should be better given the math of the situation than mine, right? Because they've done so many more companies.
Right.
Look, I think it's not like taking my portfolio and their portfolio is really going to tell you much. I mean, the funny thing about venture is even if you've invested in 500 companies, it's still entirely anecdotal. Like, that's so little data. There was another post I wrote about power laws where it said, like, you can't Monte Carlo simulate venture because given the nature of a power law distribution, any set of deals, any number of deals is really insignificant in the scheme of things of the power law. And I did some math to show that, but there was a data set of a couple thousand angel investments, and people were using that to Monte Carlo simulate outcomes. And I showed that, like, look, even given that the power law distribution we're investing on has an infinite mean, even that really large set of data is entirely anecdotal and doesn't describe the distribution at all. It's just Monte Carlo, simulations like that don't work. And I think, a similar idea that, great, well, YC has, I don't know how many companies they've invested in, 1,000, 2,000. I mean, it's a ton, right? It's still entirely insignificant in the scheme of things that you can't really draw any conclusions from their outcomes. And I think this is the sort of interesting thing. Like, you can sort of posit a probability distribution outcome and then use that outcome to model. but you can't say like, oh, well, this is what things look like. If you took 200,000 deals, they would just be like these 2,000 deals, but 100 times bigger. It's sort of frustrating working in this field because there's never enough data. I mean, the data is bad enough as it is, and there's so little data. And then even with what data we have, you really can't say much.
Yeah. And it is interesting. Another part of portfolio construction is follow-on. And if I understand correctly, you come to the conclusion that follow-on dollars are usually better spent because you spend time with the company, you have better idea about the company, and you can better allocate from there. You have a post sort of talking about the Kelly criterion. You've since edited your views recently. Why don't you talk about your thinking there?
Yeah, no, this is something I thought about for a while. I had a friend who was a trader on Wall Street, and I was having a beer with him, and we were talking about, I was trying to make sure I had pro rata rights in investment I was working on. And he said, well, I don't understand. So you're getting a call option where the strike price is the price at that time. I said, yeah, I guess. He's like, well, that's worthless, right? It's worthless. So, well, I see why theoretically it's worthless, right? I mean, if you have an option to buy at the market price, then, well, you might as well just buy at the market price. That's the market price. But of course you don't, right? And why is it different? Maybe I overthink things. But the answer is, well, I don't necessarily have the right to buy at that market price. So in some sense, it's not really the market price, right? It's not a place where the lead investor could take it or leave it. So if you want to take part of it, that's fine. They're sort of indifferent, right? So it's clearly below the market price. So having the right to invest at below the market price is always worth something. Now, I think, just my experience, in my experience, there have been times where I've taken my pro rata and times where I haven't. Typically it's, I won't take it because either I believe the new investor is making a huge mistake, which is actually has been very rare in my career. Usually it's because they're investing in a value where, my few extra bucks aren't going to make a difference either to the company or to my own holdings. So, I might as well deploy those elsewhere. But generally, I think, having the right to take it is important. And I usually do take it. I mean, I usually, at least in the second round and the third round, take my pro rata. Because I think enough about the company to know that the price that the lead is offering is below the market price. And you would know if it wasn't because you've been involved. Now, it only works if you're involved, right? But if you're on the board of a company, you're meeting with the founders, every month for a year and a half, and you're on the phone with them every week, then you have a lot better idea of what the company is worth and what those founders can do than somebody who's coming in from the outside. So I think it's, I do believe in follow-on.
So I'm curious, some people say that VC is sort of like poker or something. They're searching for analogies that I think are pretty fraught because they sort of imply that people have equal hands, and it's really about the investing component as opposed to sort of the upfront rigging of the game, so to speak, so that you have sort of better deal flow and a better brand to see more deals and to get into the deals that you want to get into. The idea that Sequoia didn't pick WhatsApp as much as WhatsApp picked Sequoia. How do you react to the ideas that I'm saying? What do you think is the best sort of a metaphor or analogy for thinking about how to have an advantage in venture or moat in venture capital?
I think about poker a lot. In one aspect, it's the portfolio management aspect. I think the idea, and I did write a post about the Kelly criteria, and then I withdrew it, or at least I put a warning at the beginning because I actually don't think it's applicable. I think that post was wrong-headed. But I do think about poker in the sense of, well, how do you decide how much to bet on each bet? And it's not entirely applicable because, unfortunately, with venture, you don't bet on one thing, find out 2 minutes later, and then bet on the next thing. And this is why the Kelly criteria doesn't work. I think it's, but there is some aspect of, how much should I bet? Like, I have a certain amount of money. How much should I put into any given company? And that's not an easy problem. I actually have never heard a great analytical answer to it. But and so it's something that I think about quite a bit. I do think it's very different investing in venture because in poker you're competing against other people, right? So what you're going to do depends on what they're going to do, and what they're doing depends on what you're going to do, right? It becomes very complicated in that sense, right? There's a lot of game theory going on. There's not really a lot of game theory when you're competing against nature. Like in startups, you're generally not competing with other people. You're, especially companies that are trying to build new markets, you're competing against nature, right? Against the unknown, against the uncaring, right? Nature doesn't care what you do. So when you compete against nature, you don't have game theory because nature is not reacting to you, right? It just is. So it's a different sort of betting. It's that, and this is again like I've been writing a lot about the uncertainty lately, and this is part of the reason, right? Is game theory is not uncertain in that sense. You may not know what your opponents are going to do, but you can kind of backtrack, and this is the whole point of game theory. Say, well, what should they do, right? And then if that's what they should do, what should I do? You can't do that when you're competing against nature, right? Because nature doesn't have a what should it do. It's just this huge unknown. What will it do? Who knows? Like, it's not going to follow some rationality.
One thing that's interesting about venture is luck plays such a dominant role in that if you have an early hit, you then become known as someone who's good. And as we talked about earlier, narratives that compounds in, all the founders want to go to the good investor. And it takes like many years to have feedback on whether you're quote unquote good or not. And so would that imply that people should start making investments or trying to build a track record as early as possible and being perhaps more, freewheeling or early on to try to get a hit to build that brand that they are good and see the returns compound from there and then be more discerning? Or I assume that a real investor would, like yourself, would react negatively to that. How do you think about that, or the broader construct that underlies it?
I don't react negatively to that. I mean, I sort of fear it, right? You're always at the mercy of your worst competitor, but I think it's true, right? I mean, people choose their investor based not just on price in the term sheet, right? If you have two investors, one of them Sequoia and the other one is somebody nobody's ever heard of, and the one nobody's ever heard of has a higher price per share, well, you still will probably take Sequoia, right? Because Sequoia has a reputation for getting great exits. So, would WhatsApp have gotten the price they got if it wasn't Sequoia, if it was some unknown? I don't think so, right? And if they can get you great exits, then it's worth it. They also, I suppose, give better advice and whatnot. I always kind of question whether that's true of anybody, but certainly there are people who don't destroy value by being on your board, and they certainly don't. Whether or not they create value by being on your board is an open question, whether anybody does, not just them. So I think having the reputation for, if you've had big exits, people will look at it and say, all right, they're doing something right. And yes, they will take your money before they take somebody else's. If you have a reputation for really knowing an industry, people will call you before they call somebody who doesn't know the industry as well, right? I mean, of course they will. So, I think being involved early and doing things like that is a good idea. And I also think that, if you're dabbling, if you're not sure, you should be taking huge risks, right? Because if you invest, $1,000 in something super risky and it turns out being worth, 200x, that's going to have a much bigger impact on your reputation than something that's less risky, but only gets you 5x, right?
Yeah.
Everybody who invested in Google early on was a genius, right? I mean, that's how we look at it now. Were they really geniuses? I mean, if you put yourself in their shoes at that time, well, it was a good technology, no business plan. A couple of founders who didn't actually want to run the business. They really wanted to sell the technology. It doesn't look like genius in that, from that point of view, but they were there, right? So yeah, that helps your career a lot. And it does make you more visible to entrepreneurs. So you will see more deal flow. And I've been doing this so long, I don't really think about this very much about generating deal flow, but because whatever I'm doing is working and I just do it and I don't really think about it. But when I talk to people who are just starting, like that's usually their biggest question. Like, well, how do I get people to call me with potential investments? And I can see that would be a problem, right? Like people don't know you're investing. Why would they call you? Like people don't just call random people. Yeah. So you need to get a reputation for being somebody who does invest, who knows what they're doing, who's a professional. All of these things are important in getting people to call you to say, hey, you want to invest in my company or not?
Let's end with some broader or some closing thoughts in the broader ecosystem. You wrote a post a decade ago about fixing venture capital. I'm curious if it would be different at all today, or maybe another question is how do you expect the in 2030, if we're back here talking about the venture ecosystem, is it kind of going to look the same, or any sort of meaningful sea changes in your view on either the VC side or the LP side of how the business is done?
Yeah, I forgot about that post. It's interesting because I've recently invested in a couple of funds. One is Tyler Tringus's Earnest Capital. Another is Brent Beshore's Permanent Capital. And their model is kind of what I talked about back then, which is, why have this 10-year life? Why look for only that kind of specific company that you can enter and exit within, hopefully 5 years? Because, given, the time frame of a typical venture capital fund, that's kind of what you have to look for. That really restricts what you can invest in. mean, how many companies can you start, get to a point where you can exit within 5 or 6 years? It's it's a very small number of companies out of all the companies that are started. Even the companies that are really valuable, like no venture capitalist would have invested in Walmart, right? It was just the time frame was wrong. So this idea that you don't have a time frame, that you're not necessarily investing in anticipation of a sale or IPO, that there are other ways to get a reward for investing in a company other than having it sell itself or go public, is really interesting to me. And those two funds are doing that. Whether or not it's going to work or not remains to be seen. Easy for me to invest in those two while I'm still investing in venture because it diversifies my portfolio. And I've written other things that said, like, I don't think that there's any middle ground between venture and bank lending. For startups, there's no real middle ground. But I'm also pretty, if there's one thing I know about myself is that I'm usually wrong, right? I mean, that's the kind of thing that venture teaches you. I'm wrong about 2/3 of the time. And, if these guys are right and I'm wrong, then I get to reap the benefit of their genius.
Yeah. Are there structural reasons that prevent sort of the you mentioned the 5-year thing, or like maybe it's 2 and 20 model, or are there other structural reasons that are why the industry has been like it's been for so long and so averse to change that could change? Or
well, it's interesting. I mean, some of the earliest venture funds were these sort of evergreen funds where the money that was made from the portfolio was plowed back into the fund and reinvested. So they were not closed end; they were open ended. I don't know what the structural reasons are that for people to prefer these kind of closed end funds. That post that from 10 years ago was responding to a comment that Fred Wilson made about how it's too bad there aren't funds that were like 20-year funds that could invest in longer term things. And it was just sort of struck me as odd because, certainly at that time, if anybody could have gone to LPs and said, hey, we're doing a 20-year fund, it would have been him. So, if he thought that was better, like he could have done it. And yet he didn't. And partly, maybe it's because he just not his thing. It wasn't what he wanted to do with himself. That's probably it. But it may also have been just because, it's not the kind of thing that LPs are looking for. And tying your money up for some indefinite period of time is hard, of course, for anybody, much less, the kinds of people who might, like LPs who might actually need the money 10 years from now. The open-ended funds back then, I think, it was like ARD, American Research and Development, who invested in Digital Equipment Corp back in the 50s. They were public companies. You could buy and sell their stock. So you could still exit the investment without having exits within the portfolio because you could sell the stock. But that model has not generally worked that well. There's been a lot of companies that have tried that. They did. A bunch of companies in the 70s tried it. The SBIC companies. There were a couple companies like Safeguard Scientific, and there was another one in the dot-com bubble whose name I'm blocking out. There were public companies investing in venture, and it was just too volatile. I think the value of the portfolio was so dependent on variables that were out of their control that the volatility was huge, and I think public market investors just said forget it. So is it possible? Yeah, maybe it's possible. I'm hoping that the people who are trying it now will make it work.
We'll have to do an episode in 2030 or before then. My guest today has been Jerry Neumann. Jerry, thank you so much for coming on the podcast.
Thanks, Erik.
If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.